Hello, everybody, and welcome to episode 8 of the Forex Bootcamp. Guys, it's been so long since I posted one of these videos and added to the course, and I'm so glad we get to smash it off with technical analysis part 5. Without further ado, let's just kick off into it, right? So what are we going to speak about today? Well, we're going to look at entries into the market. We're going to speak about stop losses and take profits. We're going to look at lot sizes, which is where you're going to find out about your position sizes, the size of your trades, and actually how to set orders on your device. So I hope you guys are really ready for a jam-packed out video. If you haven't already, go get yourself a notebook, get yourself a pen, make sure you're taking notes, and make sure you got TradingView up on the side just so you can follow on with what I'm doing, because you're definitely going to need to take notes. So, entries. What is an entry? This is something that you're going to see a lot if you're going to be consuming trading content. Okay, entries are simply your entry into the market. Okay, it's the price that you've entered at, whether you're buying or selling. The price that it is what it is. You get what I'm saying? Wherever you have bought or sold, the start of your trade, that is the entry price. Okay. There's loads of different ways you can actually get into the market, right? Loads and loads of different ways that you can get in, and there's no right or wrong way. Okay, there may be some preferred ways or maybe some better advanced ways, but this is just so you guys can get an understanding of it all, and you'll see how versatile it is, and you'll be able to piece all of this together using all of this information to be able to come up with a multitude of ways to be able to take your trades that are going to best suit how you want to get into the market. So these are all the different ways that you can get into the market. Okay, I'll just read them out for you. We've got instant execution, we've got a stop order, we've got a limit order. We've also got a stop limit order. Okay, so with all of these, okay, you're going to be buying and selling. Okay, so you will have a buy instant execution, a buy stop order if you're going to be selling, right? You've got a sell limit order. And by the way, when we talk about selling, I don't mean closing out the position. Remember from the previous videos, we can go long or we can go short. Okay, if we buy, we're going long. If we're selling, we're going short. Okay, so we've got the examples by there. But what on earth does all of this mean? Let's just go into it. All right, so instant execution is where you are literally just entering straight away. Okay, so let's say, for example, you're waiting for price to get to a certain point, bang, you press the buy button, bang, you press the sell button. Okay, some of the benefits is that you're always going to guarantee to get an order. Okay, wherever, because you're literally just pressing the button right where it is. And if you're accurate with it, you can catch price at a really, really good time. Some of the drawbacks is that you may not always get in at your desired price because of spreads. Okay, we're going to talk about spreads probably later on, but I'll just dive into it very briefly. Essentially, spreads is going to be, there's always going to be a cost to entering your trade. So the reason why, and you probably would have noticed if you've done a little bit of trading already, if you enter a trade, your trade will always enter in a little bit of a loss, like a tiny bit. That's the spread. There's always going to be a price that you're basically going to enter at. And what happens is at different times, this price, this price may be enlarged or it may be smaller. There's always a bid price and there's always an ask price. Okay, it's a bit difficult for me to really go into on a short piece of short video like this, but if you go and research that, you will basically know exactly what I'm talking about. Okay, so spreads can basically affect the designated price that you want, right? So if you have bad spreads, you may buy it here, but your entry may have been, a little bit to the upside, right? Rather than getting in exactly where you want it to be. A lot of mouthfuls there, goodness gracious, right? Without confusing you guys anymore, let's just look at the instant execution application. Before I do that, I'm going to just turn the volume up a little bit. All right, guys, I just wanted to quickly go over the application for instant execution. So we've explained previously that we obviously take long positions and we also take short positions, okay? So as you can see, this is what you're going to be seeing a lot of. This basically shows you your trade limits, okay? So this will show you the price that you entered at, this line in the middle. This will be like your target and this will be your stop loss. But we'll talk more about this later on, but just so you guys are not confused as to what this looks like, this is obviously a sell position we're expecting price to go down. This is obviously a buy position and we're expecting price to go up. So you'll typically see things like this. This will be where you entered, this will be where you entered, and yada, yada, yada. Okay, so let's just look at instant execution, right? So obviously we have buy positions and sell positions. Buy meaning you expect price to rise, and sell meaning you're expecting price to go down. So when you use instant execution, whichever order you're placing, it's going to just literally enter instantly. So some traders may do something like this, right? So they may see a key level right by here, okay? And they will say to themselves, okay, as soon as price gets to this key level, I'm going to hit that buy button, okay? So you can see it literally entered right by there. So they're going to, put their trade something like this and, do whatever, okay? Some traders may want to wait for a bounce. Right, they want to see a candle like this, and after they see that candle bounce, no matter how big or small it is, they will enter the trade. Some people might be a bit differently. They might say, okay, well, I want to wait for a nice big fat juicy wick rejection. So as you can see, we saw it right by there. So they're going to be entering their trade like so, and that's pretty much it. Let's just show you some examples for sell positions. If we were to do something like this, right, where we're expecting price to go down by here, we are going to simply wait for price to get to this level, and we're going to, obviously this is back tested, this is not live trading, so we don't have the luxury of going back in time when we're actually live trading. So you would have bought as soon as price gets by there, and then bang. And then I guess I forgot to mention, but you can see already one of the drawbacks of this method. Whilst it's pretty good, you got to use it very specifically, because sometimes you're going to buy or sell when you think price is going to go down, and what happens is it just goes in the complete other direction. But I mean, instant execution is not my preferred way of getting into the market by any means. It's actually my least favorite. There's lots of different ways, but it doesn't mean that it's wrong. So that was just to explain the application, and I hope that made sense. Okay, so I do hope that made sense for you all. It's just a recap. It's what the name says, right? If you see price, you want to buy that price, you enter instantly. Instant execution. No more needs to be said, right? Stop orders, okay? This is quite interesting. Now, guys, I want you to look at the diagram, okay? And I want you to just take a moment to look at where you can see buy, stop, order, that first little drawing, okay? Let's just assume that price is moving in this direction. That buy, stop, order, right? Whatever price you've set it, as soon as price hits that level, boom, the trade is triggered. Okay, so you set it in front of price. So if you were expecting price to rise, let's say for whatever reason, you've bought Euro USD at 1.23 for whatever reason, and you were expecting price to rise, you will say set your buy stop order at 1.235. Do you see what I'm saying? So the reason why these are, probably more preferred to a majority of traders is that it gives them time, it gives them a little bit more confirmation that price will go in their direction first, right? With instant execution, you could take a buy position and it could literally instantly go, against you, right? Like the next candle could just go completely against you. But with this, you're going in line where the direction already is. So it's like you set a limit, you set like an area where if price gets to, your trade is triggered. It's like being on a train, right? When price is moving, when that train is moving, boom, you just jump on and you ride the wave with it. The exact same is true for the sell stop order. You just set the price where you want your trade to get triggered, and if price travels down and hits that level, boom, the sell position is triggered. Okay, so some of the benefits of this, right, is as I explained, you've got more confirmation that price is going in your direction. So let's assume though you're waiting for price to get to a key level. Instead of entering instantly when price is at the key level, a stop order, you can set it, let's say for example you're buying, you set it a few pips, upwards. So if price was to just continue going down, it won't trigger you in, right? And obviously if it's going to go in your direction, then it's going to trigger your trade. Happy days, right? You just probably mitigated a lot of losses there. But some of the drawbacks is that you have to use it in a very specific way, and sometimes you may not always get in on the move, okay? Which isn't really too much of a huge issue. Like if you miss certain moves, as I said here, we'll talk more about psychology in later pieces in the course. So I guess with instant execution, you're always going to get into a trade, but those trades may not always work out for you, right? In the same way a stop order would. But likewise, those moves you would have been able to get in on with the instant execution, you may have missed on the stop order. So it's just something for you guys to get an understanding of and then be able to go and do some testing on it. So let's go ahead and look at some examples.
Okay, let's talk about stop orders. So stop orders are actually my favorite way of getting in the market. I get into the market all the time using stop orders. Literally number one on my list. So, and again, I want to kind of reiterate, guys, the methods that I'm kind of showing you are just examples. If you guys want to be creative and use your own ways of getting into the market, feel free. I'm just kind of showing you what I've seen and, you know, how some traders will typically use stop orders or other ways of getting into the market. All right, then let's have a look and just go at a random point in time. Just go by here. And the reason why I like stop orders is because you can be so versatile with them. A stop order would look like something like this. Okay, let's say, for example, actually, let's just go by here so we can see an example that will work out so you guys don't poop yourself. Okay, let's say for whatever reason, you've concluded that price is now likely to go down by here. So the way you will set your stop order is something like this. Okay, your entry price will be by here, put your stop loss by there, whatever it is. And if and only if price travels down by here, you will get triggered into the trade. So you can see there that you got triggered in, kind of smashes in and does whatever it wants to do. And that's pretty much it. Let's look at a buy example. If we are, say, by here, and we're expecting price to rise, you know, you can set your stop order above a candle if you want to wait for a candle, or if above some structure, or if you want to wait for price to get to a key level, which is what I do very, very often, okay? I will let price get to a key level, okay? And if it wants to go in this direction, then it will go in that direction. You know, maybe for a short period of time before hitting my stop loss, but more often than not, it goes in my direction the way I want it to, okay? So that's pretty much it. You see how we waited, set the order, and then it triggered us in, okay? And that is stop orders.
Nothing else needs to be said. Goodness gracious me, I haven't even made this, this video in a long time. I'm kind of proud of myself thinking, well done, Joseph. Well done, Joseph. You've done some good explanations now. Let's crack on, okay? Let's carry on. Sell limits. Well, sorry, limit orders. Let's not jump the gun, okay? A little bit similar to the stop orders, but there's a very big difference. Okay, similar in the sense we're waiting for price to get to a level first before our trade is triggered, but different in the sense of how we are, getting into the market. If you look at a stop order, we had to wait for price to push through that zone, right? You have to push through that zone. Whereas limit orders, we're waiting for price to kind of tap into a zone and then move off. Okay, so if we're expecting a buy limit order, we're going to be setting the order behind price, not in front. Okay, so obviously with the stop orders, the trigger point was in front of price. Now it's behind price. So if we're expecting price to rise, we're going to set a limit order. Price will need to retrace, tap into that level, as you can see to the diagram on the right. It triggers and boom, it pops off to the upside. Similarly with sell limit orders, we're setting our order there. We're expecting the retracement back to that certain level. It taps in, and as you can see on the diagram on the bottom right, boom, it taps in and slams to the downside. Very, very, very simple, right? So some of the benefits to this, right, is that all you guys got to do is set the order, and if price comes in, it taps in, boom. You ain't got to do no thinking, ain't got to do no instant execution, fiddling around. You can set the order, wait, and if it triggers, bang, it triggers. And with limit orders, you can get in, honestly, at some of the best prices. Because you waited for that big pullback, and it just literally will just, sometimes it'll tap in and poof, it'll just ping off, literally. But obviously, the opposite is true. Sometimes you get triggered in. Like let's say we're expecting a, price to rise. We set a buy limit. We got that little, level. Amazing. We're waiting for price to retrace. It taps into that level and it just, boom, continues slamming down lower. It's going to happen sometimes, guys. This is why you guys need to do a bunch of testing. You're going to see the good, the bad, and the ugly, and the beautiful. So with trading, I'm going to give you a little nugget. There's always like an equal and opposite reaction, as is with everything, right? If with limit orders, you're able to get in at really good prices, you've also got to understand that sometimes you'll get triggered in and it'll just slam against you. Don't get disheartened if you see that happen 5 times in a row one day. If you have only if you have tested it, right? And you've seen that over a number of trades it works, then you don't need to worry about it. But we'll talk about that in a later piece, right? Another drawback is that price may not always reach that point. right? You're waiting for that good entry, and before it taps into that level, boom, it's already moved. So you've got to understand, sometimes it's not going to work out for you every single time, but as long as you understand how that works, I've done my job. But let's look at another example.
All right, guys, let's go over limit orders. So you've all just had the info given to you. So let's have a look at how you can basically apply this, okay? So remember, guys, this is all just to give you the idea, but your creativity is going to shine in how you can use these orders yourselves, okay? Let's just kind of look at some examples and see. Does price want to... Okay, cool. So this is an example. I know that price went in the other direction, but just work with me, okay? So limit orders are used in such ways, okay? So if we are looking at a buy position, we will set our entry by here, stop loss by there. As soon as price gets into that level, boom, it gets triggered. So do you remember before in that example we had with the instant execution, you can see how you'd rather use a limit order for something like that. There's no point in setting, opening the position right by there, when you can just set a limit order, or you can set the limit order by there, for example. I know in this situation it didn't actually work out, but we can do something like this, okay? Where, let's say, for example, we recognize a cute little double top pattern, which you guys should know about by now. We can set a limit order like so, okay? We can say, let's wait for price to get to by there, and then we're going to wait for price to come and trigger us in. It does exactly that, and then it just goes off, and I think news comes out and then just completely wrecks us, but that's normal. You can use it like this, for example. We could have had a sell limit all the way up here. You could have set it by there and wait for price to come and trigger you in, and then it does whatever it wants to do, and boom. Do you know what I mean? So you can use it in a multitude of ways, so long as you know the principle of how it works. Looking at buy limits, okay, we will, do the exact same thing. Let's look for an example where it would actually work out for you, so you guys can have a little bit of confidence. And I know you guys, want to see things work, so let's just have a look. So you use a situation like this. You think that this is a key level, price will bounce from here. You're going to set your limit order around by there, like this, boom, and you're going to wait for price to go ahead and trigger you in, and there. You see how you get a really good entry, whereas if you're using a stop order, your entry would be by here. If you're using instant execution, it might be around by here, because you will not always get filled at the price you want for instant execution, but we'll get into that. But yeah, you can use it a multitude of ways. And guys, this isn't just specifically for key levels. You could set limit orders or stop orders or any traders any way that you want. I'm just giving you examples on how they can be used.
Amazing. And I just had a literal revelation of how I could explain spreads to you, because I think I did a poor job in the previous time, right? With spreads, there is, with any bit of trading, there's always an ask price and there is a bid price, if I'm not mistaken. This is a small little gap, which basically means that if you say buy at a certain position, you will basically get filled at a price that is a little bit later. So if you have a spread of, say, I don't know, you see like you'll go into your thing and see like a spread of, sometimes you might see something like 3, which could mean like 3 pips or 0.3 pips. It basically means that if you buy right now at the current price and the spread is 3, then you will basically buy with an increase of 0.3 pips. Does that make sense? So you're buying at a little bit of a worse price. With instant executions, you're never going to get your price exactly how you want it. But with stop orders and limit orders, most of the time you genuinely do. You get it very, very close. So that's also something to pay attention to. Okay? Now we're getting into something very, very funky, which is stop limit orders. And it's simply a combination of the two. Okay, so a stop and limit price are both set. So the stop price has to first get triggered. Okay, so we're going to use our information from the previous examples. We know what a stop price is, we know what a limit is. So a stop limit will basically mean that we have to set 2 limits where price has to hit them both, and on the second, it's triggered. So it has to first hit the stop, and then after it hits the stop, it goes back to the limit. Once it hits the limit, it's triggered. So you can see from the diagram, we've got from the first point on the left, we can see that we've got the stop price and the limit price. We can see from the diagram that boom, it smashes through, stop is triggered. Amazing. As it retraces, now it hits our limit price. As soon as it hits that limit, it is literally set and it's all done. The trade is hit. Okay, and obviously for sell positions, we just have to inverse it. That's literally it. Okay, so let's look at some examples.
Okay, let's go into stop limit orders. Now, this is a bit of a confusing one for you guys, so make sure that you've looked at that diagram if things were getting a little bit confusing for you. But essentially, it's just like it's a very confirmation-based way of getting into the market. So I personally don't use these, but I probably will start to use them because I've been developing some ideas. But let me give you an example of, let me give you an example of how you could use something like this. Okay, so let's look at this. Let's look at this scenario. Okay, let's consider that you recognize this as an area where price is likely to fall. Okay, so you have a specific setup played out. And what you want is to get in at a really good price. So let's say you want to get in at around by here, okay? But you need to see a few things develop first, okay? So you want to see price basically get down by here first, okay? And then once you've seen that, then you can say, okay, it's likely that price will retrace from there, and then I can get a nice entry around by here, okay? So you set this as your stop, okay, as your stop price. Okay, and then you set this, okay, as your limit price, okay, and we're assuming a sell limit, okay, sorry, a sell stop limit, right? So when we see this, okay, the stop price gets triggered. Now let's wait for price to come back. Okay, let's just assume we set it by there, just for argument's sake, okay? It comes back, and now it's triggered us in. So our trade would look something like this, okay? So you can see how you can piece together some really good confirmation. You can piece together some really, really good confirmation, and then, you're on your way to making a whole lot of cash, But again, use your creativity on this, guys. That's kind of like how I would get into the market. Some people may do something like this, okay, where they will say, okay, I want to see price, get below here. So here's going to be my stop. Okay, my stop's going to be by there. Let me just delete all this. Okay, my stop price is around by there. My limit price is around by there. We're waiting for price to come back to here to trigger the sell limit, and then boom, it finally comes back. But unfortunately, it didn't play out in your favor, and you took a small little stop loss. No big deal. Okay, so with stop limit orders, it's typically used to combine really good confirmation and then a really good price.
Awesome. There we go. So you got all the information there now. So that is all when it comes to entries. I don't know there's any other entries, any other, I'm pretty sure that is everything there is, guys. We're going to talk about the platforms that you guys can use to take your trades from, and that's all you're going to see. Everything I've shown you is all you're going to see, and it's all you're going to need. You're not really going to need to use all of them in intricate ways. When you build your strategy, you're probably going to just have one or two and let your creativity do the work. When you find out how you want to enter the market, you'll be able to go and smash it. But you've got all the information there, and I'm so glad I was able to give that to you. Let's carry on and look at stop losses and take profit. For those of you that already know about trading, or maybe if you guys have only just started watching this course and you've done your own research, maybe you already know what stop loss and take profit is. But for those of you guys that don't really know what on earth I'm talking about, a stop loss is a price in which it's basically price that you set for a trade, where if it triggers, if it travels to that direction and hits that level, hits that price, it will automatically close your trade out for a loss. Okay, so why is this important? It's absolutely essential to profitable trading. Okay, and we'll talk about more about this in a little while. But your stop loss should be the level in which you say to yourself, okay, if my trade is wrong, where am I going to see price travel to for me to consider that, yep, it's done, just finish it. Because you don't want to keep your trade running in stop loss forever. It's going to trigger at some point. Okay, so that is basically what it is. It's the way that you protect yourself so that price doesn't fall too far, and you just after it's traveled for a certain while, you say, okay, the trade was lost. No problem. No big deal. Okay. Take profit. Okay. This is basically the target that you're setting for your trade to close out for a profit. As soon as price hits this level, boom, you got cash, baby. Cash. All right. And it's basically it's the level where you're happy to close the trade out. Okay. what you class to be an acceptable profit target. In my opinion, the stop loss is the most important aspect of trading. It's going to be what you're going to focus on majority of the time. But with take profits, you don't necessarily. Same with stop losses, right? In order to close your trade out for a loss, you don't have to use a stop loss. And in order to close your trade out for a profit, you don't have to close it out with a take profit. These are just levels, limits that you set. When I say limits, I don't mean like limit orders or anything like that. They're just prices that you set so that when price hits this level, it will close it out either for a profit or for a loss. But you can close it out manually. I wouldn't advise that, and we'll talk more about that in the psychology piece. But for now, just know this. The stop loss is the price that you're setting where price will trigger and close you out for a loss. It's a way of protecting yourself. And take profit is essentially your target, and that's where price will close you out for a profit, right? And I just wanted to bring you into something, guys. Successful traders don't look at their profits, right, or losses in monetary amount, right? You might be thinking, oh, I made $50 on that trade. Oh, I lost $100 there. Oh, I won $1,500. Okay, this is what amateurs do, right? Real traders monitor their wins and losses in percentage gains or R multiple. Okay, and we'll talk about that on a later side. Now, this might shock you a little bit, or you guys may have been drawn in by the guys making loads of money on Instagram or whatever it is. But trust me on this, guys. Do not look at your trading account or your trades in terms of money, right? In terms of how much you've won per trade, because it is futile, honestly, and you don't even need to. Trust me, when you get better at this game and you get more capital, you'll be making loads of money. So don't think too much about it. It is going to profit you way more to think of your wins and losses as percentage gains or in your R multiple. And as I said, we'll talk more about this later on. Okay, so you probably already seen, I just wanted to show you just very plainly, when we look at TradingView, the green and the red, that is exactly what I just spoke about. The red is your stop loss, right? The final point you see right at the bottom where the sort of rectangle is finished at the bottom, that's going to be the price that your stop loss is, and that's basically where the where the trade will get closed out. The exact opposite is true for the take profit. That top bit there would be your take profit level, and everything in the green is profit, everything in the red is your basically your trades in the red. Okay, and as we said, guys, take profit is a target for your trade, closes out for a profit. Your stop loss is the level you're able to accept that you are wrong on a position, it closes you out for a loss. But what's also interesting and really, cool about the stop loss is that it encapsulates your risk, your dollar amount per trade. So if you want to say lose $30, it's all going to be set using the stop loss. Okay, we'll speak about that in a bit, right? Why is it so important to consider this? Okay, profit taking and mitigating risk is absolutely essential to profitable trading. And this is why TPs and stop losses are so important, right? Beginner traders are always going to make this mistake, guys. As long as the sun rises in the east and sets in the west, traders are going to do this. They're going to close their profits out too early and hold their losing trades for too long, right? Stop loss and take profit eliminates this, right? As you get into the trading, especially when you use real money, your psychology is going to be tested massively. And I would literally not doubt if almost every single one of you started off and you made this mistake. But don't worry, it's okay. I'm here to tell you everyone does it, but let's try and mitigate it. Why don't we, right? This will actually help you, okay? Don't listen to what anyone tells you. Just understand this simple truth. Trading is simply just a game of wins and losses. It's not about who's the smartest. It's not about who's got the best risk to reward, who's got the best ideas. It is simply a game of wins and losses. In order to win money, you have to potentially lose money. And what you're going to find is that when you have an edge, okay, we'll talk more about this in building your trading strategy. When you have an edge, which is a statistical advantage against the market, which has been proven by loads and loads of testing, then all you need to do is simply execute this edge, and guaranteed over time you will make money. So if you think, guys, that you want to limit your losses as much as possible, that's good, amazing. I implore you all to do that. But don't think that you're going to avoid them. And don't think that you are better than any other trader who may have a losing streak. You're going to have losing streaks. And trust me, guys, I know this because of experience. Even if you have a strategy which is tested to have a win rate of like 60-70%, which again is very rare, and you don't need a strategy like that. My strategy works amazingly well, and my win rate is 30%, guys. You might be a bit confused as to how that could work, but I'll talk about that later. The point is, guys, if you have a really high win rate strategy, it doesn't mean that you can't take 5, 6, 7 losses in a row. It's just going to happen. You just got to accept that losses are going to happen. It doesn't mean you're a bad trader. It doesn't mean anything. But accepting that you've got to use your stop losses and take profits is essential to good trading. And what is good trading? It's profitable trading. Good trading is consistent and methodical. Okay, bad trading is trying to make as much money as you can and ignoring risk. I promise you. You may do option 2, you may do the bad trading and think is great, but you're not going to be there in the long run. The guys who do good trading, they may start off a little bit slower, but they're going to be the ones who are going to be in this game making the big cash after, 2, 3, 4, 5, 6 years. Right, continued now. The secret to trading, right? Profitable trading, it's not about winning more trades than you lose. Contrary to the belief, people think that you have to have a 50% win rate strategy, or you have to win more trades than you lose. It's literally not the case. The secret is to win more profits when you are correct and when you're wrong, and this is all going to be found in your risk to reward. So whenever you set a trade, now you know about your stop loss and take profits, you're going to have a risk to reward. Okay, what is risk to reward? It basically means what is the ratio between what you're going to risk and what you're going to make. Okay, if you risk $50 and you made back $50 on that trade, your risk to reward was simply 1 to 1, right? If you have a 1 to 2 risk to reward, right, you basically mean that you are going to risk $50 to make $100. If your risk to reward is 1 to 3 per trade, it means that you're going to risk 1 to make 3. Does that make sense? And your stop losses and your TPs and your your overall I guess results should be measured in your R multiple. Okay, and what is your R multiple? Well, it's basically about your risk to reward, right? So if you basically risk $50 per trade, your R multiple is how much you win. So if you won $100, you've obviously won 2R. If you won $250 risking $50, then you made 5R profit. Okay, if you risked $50 and you lost $50, you lost 1R. Okay, let's say in the entire week, you calculated all your wins and losses, and you say, I lost minus 2R this week. That basically means you just lost $100. But tracking it this way is way more beneficial. And when it comes to percentage gains, I just want to literally sneak this one in there. If you look at your account in terms of percentage gains, it's going to fare you way better, because people think that trading is all about making a load of cash off a little bit. It's absolutely not. It's about making little bits off a big bit. So if you have $100, like think about this, guys. If you have $100 and your friends say, oh, how much did you make last month? You say, well, I made £5 or $5. They'll say, look at this guy making £5. What are you, a crap trader? Right? You see some other guy says, yeah, I made £50,000 this month. Right? But that trader at 50,000 has 5 million in capital. But the guy who has £100 or $100, right, only has $100 in capital, right? But that guy who made $5 on the 100, they made 5%. That's amazing. Now you have $1,000 and you make $100, you made 10%. That's fantastic. So if you can consistently say make 5% a week or 5R or whatever you're dealing with, that's going to fare you way better. Because if you consistently make 2 to 3% a month or 4 or maybe more, right? Imagine when you have like 200K in capital, right? That 2 to 3% is now going to be like $3,000 to $6,000, right? And that's all you guys need. So the trick is, guys, to have a positive risk reward. Okay, if you have a risk to reward, if you basically every single time you place a trade, you go for a 1 to 3, okay, that means that you can lose 7 trades out of 10 and you can still be profitable. Did you catch that? If you have a risk to reward of 1 to 3 per trade, you take 10 trades, you lose 7 of them, but you win 3 of them, you'll be in profit. So think about it, guys. Okay? Think about it. Right. We're going to talk about where to set your stop loss and where to set your take profits.
Yo, people, just a quick one. I just want to show you guys, as a general rule, where you should be placing your take profits and your stop losses. We're going to start with stop losses because this is the most important part of our trading. And I'm just looking at the gold on the 15-minute time frame, and I just want to show you guys just some stuff, okay? Just keep it very, very simple. Let's say, for example, you are going to take your entry around by here for whatever reason. Let's say you go by there and you put your stop loss like this, okay? Let's just use the bar replay for a moment, and let's just say that this was your entry, okay? For whatever reason, you bought by here and you just put your stop loss in a random place like this, okay? Even though I know just from looking at it, literally 2 seconds ago, that this trade actually ended up winning. It's still not a good example. Why is this not a good example? It's because your stop loss is not being protected by anything. So whenever you take any kind of trade, you need to be thinking about your stop loss and where it's going to be protected, right? And you will find this in key levels like so. If you see an area where price is failing to break, or you have an area like this, okay, this is a key level as well, you just need to have it protected by a key level. Why is this important? Because not always when you take your entry, right, is price going to just shoot off like it did here. A lot of the time it's going to muck about around by here, and you don't want to be caught in a situation where, let's say you put your stop loss by here, right, and it's getting taken out and taken out and taken out, and then it pumps up. You just want to put it in a place where price is clearly rejecting. You want to encapsulate all of the wicks, and you want to seriously just keep your stop loss in a nice, safe place. And that is the general rule. When it comes to the take profits, though, that's going to be something that is, a lot more subjective, I would say. You have lots of different things. You can maybe want to set your maybe want to go for set 1 to 5s. And I just wanted to quickly show you something, right, guys? When we look at our risk to reward, right, when I talked about it in the previous slides, you don't have to calculate anything on TradingView, right? It's all there. Can you see right by here? You can see risk to reward 5.1. So all you guys need to do is just set your stop loss, right? Make sure that your stop loss is prioritized every single time. And then you can look towards your take profits, right? And if you are, a few things that you can do is you can just set take profits. Maybe you want to just go for consistent 1 to 3s, and you're not going to worry too much about key levels or anything else. You just want to set it and leave it. Maybe you want to expect price to make new higher highs in an uptrend and set your take profits maybe a little bit further. Maybe you guys want to look at key levels, right, and say to yourself, well, maybe I can see from my testing that price tends to reach these key levels, so I'm going to set my take profit around by there and just see what it wants to do. Okay, there's loads of different things you can do for take profits. The major point is that you are having a positive risk to reward. Okay, what you absolutely don't want to do, guys, is have a risk to reward where you're winning less than when you lose. So if you have a risk to reward of 0.54, you've risked 1 to make half. Doesn't make any sense, right? Sometimes you guys will have a strategy where you want to take 1-to-1s. I personally don't really go for them at all, but some people like to use them. For me personally, minimum 1 to 2 is okay. If you're aiming for 1 to 3s, 1 to 4s, that's also amazing. If you can get more than that, then that is fantastic. Your real success is going to be determined by your risk to reward, right? So just as a quick recap, stop losses, always have them protected. Don't have them in a random place. Yes, okay, you may take some random trades where your stop loss is there or your stop loss is there, and you may get a couple lucky wins, but more often than not, the market's not always going to act like that. You're going to be better off placing your stop loss in a place where it's protected by a key level, and then the take profits is something that you guys are going to find out for yourself. What kind of profits do you want? Where are you going to exit? Do you want to set your TPs at higher time frame key levels? Do you want to set it at lower time frame key levels? Do you want to set just standard 1 to 3s, 1 to 2s, 1 to 4s? Whatever it is, that's up to you. But the main premise for your take profits is that you want to have a positive risk to reward.
Whew, I think we got through that. Guys, I really hope you're taking your notes down because you're going to need them. Right then, so that pretty much covers stop losses and take profits. So we're going to speak about lot sizes. And the first thing I want to talk about with lot sizes, actually, before I get into that, lot sizes simply is goodness me, can't even get my words out. What is a lot size? It's basically the size of your trade. So our trades in terms of size are measured in lots, okay? And I just want to show you at the bottom of the screen, right? this is what you're going to see when you go and plug your numbers in to set your trades. Okay, you have standard lots, which is, this is just like a general thing. Standard lots means that unite, so that's the spelling error, 10 units of currency per pip. Mini lot 0.1, so you literally go and type in 0.1 into your current trade. It would basically mean that it's 1 unit of currency per pip, basically meaning if you're trading in dollars, it's $1. Okay, for the standard lot, it's $10 per pip. Micro lot is 0.01. It means that you've got 10 cents. Goodness gracious me, math's terrible. Yep, 10 cents per pip. Okay, so what on earth is a pip? A pip is what we basically denote as price in percentage, okay? And whenever you're looking at any kind of exchange rate, it's always the fourth decimal place of price. So if we have Euro USD, for an example, we see 1.23354. We always have 5 decimal points. I want you guys to just completely ignore the 5th decimal place. So let's say it goes from 1.23354 to 1.2342. Okay, what this is, right, if you go to the right, it's just a simple subtraction. Don't worry about the 1 point whatever. You just take the 4 digits, after the decimal place, you go 1, 2, 3, 4, take those numbers, you subtract them, and you've actually got a 7 pip difference there. Okay, so that's all pips are. It's just, a way to gauge price moving. It's a way to gauge distance. Okay, so let's say you set your trade by here at one level and price moved 50 pips, you can see how far price traveled. Okay, and whenever you use standard lots, micro lots, or mini lots, or whatever, you don't have to always use this. You could set 2.0. It just means that you're going to have, let's say, for example, you're using dollars. If you set a trade size of 2.0, right, 2 lots, it means that $20 per pip is going to move, right? If your trade moves for 50 pips, then you've got yourself, what is that? $10,000, okay? I think. Don't quote me on that. Right, mini lot, let's say, for example, you have a trade size of 0.62. This means that you've got 6.2 per pip. I had to think about that one for a second. If you have a micro lot of 0.04, it means you've got 40 cents per pip, right? If we have a lot size of 6.73, right, that means we've got 6.73. It means we've got $67.3 per pip. Okay, so. And by the way, it's only to the 3rd decimal place. We can't go any lower than that, than I know, really. You can't go any lower than that. So that's basically what we do. So we'll calculate our stop loss sizes, in terms of pips, and then we'll be able to say, okay, let's say I want to risk $50, right? Then you pretty much know how to sort of calculate that. Well, at least you think you do, right? I'll show you how to calculate it in a moment, but I just want to show you something really, really easy for you guys. Whenever you set your trades, TradingView does half the work for you. Whenever you set your stop loss, you see that red box? You see I've showed you an arrow? See that 15.5? That's 15.5 pips, okay? So you know that your stop loss size is 15.5 pips. And all you got to do with any trade, anything, guys, you just literally set your stop loss, click on it, go and see whatever number is in that space that I just pointed to with the arrow. That's the amount of pips. Okay, and the best part is you don't even need to calculate your lot size because we've got position size calculators on the internet for you. So I'm going to go ahead and play this so you guys can know how to calculate your own trades. Technology is great, right?
Okay, guys, I just wanted to quickly touch up on something, right? We don't even really need to calculate our position sizes ourselves. There are calculators online that can do this for us. So if you guys type into Google, my FX book position calculator, let me just go here and say my FX book position size calculator. I click on this one by here, and then boom, I'm at that website you just saw me click on, okay? So the reason why this is really useful is because if you are, say, for example, trading Euro USD and you are using Swiss francs, right? In order to get the correct position size, you also need to incorporate the conversion from Euro USD to pounds, right? It's really confusing, and it's way easy. Oh, sorry, to Swiss francs. It's way easier to use a position size calculator like this, which takes into consideration that conversion. Granted, it's not like 100% accurate, right? It's not like you'll get down to the last penny accuracy, but it's definitely good enough, guys. I can promise you that. And we'll talk more about this later on when we really get into like practicing our trading. Just use a demo account, if you wanted to do this, right? We'll speak more about the demo accounts and live accounts later, but let's just look at this as an example, okay? Let's go back to that trade that we were looking at in the previous slide, we can see, all we need to do to be able to calculate our position size is firstly see how big our stop loss is in terms of pips. And that is simply by clicking on this box, and you can see by this number, if I wanted to increase it, right, I can see that number is now 25.1. If I wanted to decrease it, I can see that it's now 14.1. So all you guys need to do, I'll just show you another example very, very quickly. You just click on the box, you fiddle around, set your stop order, and you just look for that number right there. You can't miss it, guys. Okay, so we can see that we got 14.1 size stop loss. So we can go ahead and just type in 14.1. But before we actually do that, let's fill in the stuff by here, right? So the currency pair, this is the pair that we're trading, and right now we're looking at Euro USD. So all we got to do is just click on Euro USD. But if you were trading something else, you would just go and type that in there. Okay, account currency, whatever currency you guys are trading with, if it's dollars, if it's pounds, if it's Swiss francs, this is where you'll click into this. So we did say Swiss franc for example, so we're going to go ahead and just put in CHF. If yours isn't on there, pardon me, then I'm not too sure what to advise you guys. I would just say go online and double check how you can do that. I myself have literally forgotten. It's been so long since I've ever calculated all myself. It's way easier just to use the position size calculator. Okay, the account size is how much capital you have currently. So this is not really too much. You don't really need to worry too much about this. But if you ever wanted to, calculate how much you're going to be risking as a percentage of your account, then I guess you can keep it in there. But for now, just keep it simple. Let's say you're trading with 3,000 Swiss francs. Okay, obviously, if you were trading, AUD, you would just put the exact same thing in there. This is just how much is in your balance, right? Pardon me. This is the bit where it gets interesting. Okay, so for here, guys, I would just click on swap with money. Okay, don't worry about what the other option is. Just don't focus on it. Swap with money, because you guys are going to be setting out your risk in terms of how much you're risking, right? So if you want to risk, say, $20 per trade, you put that in there. Or 20 Swiss francs per trade, you put that in there. Or let's say, for example, you go on to 50, we'll talk about how much you should be risking later on. But let's just say you're using 50 Swiss francs, okay? You put your stop loss in, lovely jubbly. Don't worry about this. Don't click on this. Just forget about it. You just make sure that you've done all of this correctly, as I've shown you. You press calculate, scroll down, and there you have it. You just type in 0.39 lots into your device. I'll show you how to do that afterwards. And once you set that, guys, this amount, right, if your stop loss gets triggered, you are literally only going to be losing that $50 or that 50 Swiss francs. If you wanted to say, for example, risk $20 with those exact same metrics, it would change to 0.16. Okay, so this is going to be your position size, and we'll speak about how you can set these trades in a moment. But it's really, really important, guys, that you get this down, because what you don't want is to be not knowing how much you're risking per trade. It's a very, very crucial part, and we'll go into risk management in a later piece.
Amazing. And I just wanted to touch up on that, guys. I think I kind of waffled a little bit. When it comes to the account currency, right? If your trading account is in pounds, if your trading account is in Swiss francs, Australian dollars, just double check that, okay? Just double check whenever whatever you're investing in, make sure that when you go to the position size calculator, you're filling out all the correct options. Make sure you're putting in the pair, right? If you're trading AUD USD, put that in there. If you are using pounds as your currency in your trading account, right, you put the GBP in there, and then you fill out all the other bits of information, and then you make sure how much you decide to risk, right, $10, £5, whatever it is, you also put that in there, fill out everything properly, and it will give you a very accurate, very accurate position size, so that when you lose that trade, you know that you're getting very close to, if not identical to, the amount that you want to risk. You do not want to be, like I said, you don't want to be in a situation where you haven't taken these into account, right? And you want to risk $20, but you end up losing like 35. Nobody wants that. Okay? So setting trades. Guys, you probably have seen this everywhere on social media, right? All of those people posting profits on that nice white screen, and it looks really simple and easy. This app is called MetaTrader. This app is called MetaTrader. I myself use MetaTrader 5, but you could use MetaTrader 4 if you want to. MetaTrader 5 is just more advanced, not in the sense of like it's more complicated, but it's just like an upgraded version. So I don't see why you wouldn't want to use it. This is probably the most popular trading platform, but there are other trading platforms, okay? But I'm going to show you what MetaTrader looks like on your phone. But I also advise you guys in your own time to download it on your laptop and get used to it. Get a demo account, find a broker, get a demo account, log in. And basically it's way better to use your laptop than your phone, because with your laptop you can quickly plug numbers in, you can quickly navigate it. With the phone it can be a little bit flimsy, but if you're just starting out to get an idea of how to navigate it a little bit, granted the navigation on the phone and the laptop is different, but you just want to get used to, I guess, the foundation. You want to see the charts, you want to be able to see the pairs, you want to be able to know where to set your stop loss and set your trades, etc. Just go ahead and look at the rest of this, okay? So taking some screenshots, guys. When you download MetaTrader 5 from the App Store or whatever store you're using on your phone, it will look like this. So this, if you click to the bottom right and click on chart, you're going to basically see a chart. But you shouldn't be doing any of your analysis on here, guys. You actually pretty much should only be looking at chart just to maybe double check how your trade is doing. Okay, you don't do any analysis on this. You do that all on TradingView. It's way easier for you. Now, if you go to the bottom left and click on quotes, you're going to basically see all the pairs there, right? I didn't include what happens when you click on one of these, but you guys can figure it out when you're fiddling on your phone. If you can click on that, you can look at so for example, if you click on USD CAD, you can literally tap it with your finger. You can bring up, the chart itself, or you can also set up a trade, right? Also on the home page, if you go to the middle where it says trade, that's where you're going to see your trades, and you can also see your balance. You can also see your equity. You don't really need to worry too much. All you want to focus on is just your balance, really. The rest isn't really too important. When it comes to margin, that's basically how much you need in your account to be able to set your trades. You don't really need to worry too much about leverage or anything like that. If you do want to go and look into it, I'll just tell you quickly what it is. Basically, leverage is the amount that you're able to borrow to basically place trades, right? You don't really need to worry too much about it. You guys shouldn't be looking to get margin called, which is basically where your broker will cut off every single trade because you've lost way too much, so you actually can't use any of their leverage. You don't need to worry too much about that. But if you want to go and get your inside information, go and just Google what margin is and what leverage is. But like I said, you don't really need it. So back to the topic at hand. If you click on the plus sign at the top right corner, what you're going to get is your trade interface. Okay, so if you look at the middle, right, if you look at the middle picture, that is pretty much what it's going to look like just off the cuff. Okay, that number that I've circled in the middle is where you're going to select your lot size, right? You see how it's all coming together now. If you click on market execution, you'll get what you can see on the left, which is all of your entries that I was telling you about, the ways of getting into the market. Woohoo, amazing. It's all making sense, right? So if you want to set a buy stop, you click on that, and then you can go ahead and set your limits in. And you can see where it says stop loss, take profit. You can see where it says price. If you look at the far right, you'll be setting a buy limit. You click on the middle, but you click on the middle number where it says 0.01 to set, your lot size. You'd also on the right set your limit price. You'd set your stop loss. You set your take profit, which can all be found on your trading view when you just click on. The actual, the green box, you can literally go to the right. You'll see it all there. It's just parallel, right? But if you wanted to, guys, let's say, for example, always double check this. When you set your trade, you see that green arrow, just double check that you're at the right pair. So if you want to trade gold, double check it and make sure that you're at the right commodity, the right currency. If you're trading Euro USD, you don't want to see XAU USD. It's gonna if you set like a lot size based for a currency on gold, you're going to get destroyed, because gold is a different way of calculating it. Okay, we don't need to worry about gold. It's way easier, right? You can go and look at that in your own time. But if you did want to change the currency pair, you just click on that, click on where it says XAU USD, and it's going to bring up all of those currency pairs, right? And lastly, this is what it's going to look like when you want to set your trade. Okay, you just type all your figures in, right? For this, you'd have a buy limit of 1.03, a stop loss of etc., take profit of whatever. Funny enough, it's all the same price, but you obviously just go and change those numbers. And when you're ready to place your trade, that area where it says place will be highlighted, and you can go ahead and press it. And it's just as simple as that. You guys can go and get a demo account literally today, go into a broker, open a demo account, and you can just have a fiddle around and just see how to, put this all into perspective. And you can literally see it all for yourself. So that is pretty much everything, guys. I hope it was really informative for you. You guys probably need to go and maybe watch that a couple times to really get your head around it. But what are we going to look at next? Okay, guys, we're literally getting to the last couple of episodes, which is going to completely close off this course. And you would have been from a place of not having any knowledge about trading to being able to have a very strong understanding of how to piece together your plan and ultimately take trades. Remember, guys, the aim of this course was not to make you pro traders. It's just to get you, get you into the game and get you to understand it all. You don't have to risk any money. You can have it all, all for free by here. So the next video, we're going to talk about risk management. Okay, we're going to talk about finalizing your trading strategy and talk about your edge, which I don't think is something I've really spoken much about, but we're going to really, really focus in on what that means. We're also going to look at back testing and forward testing, which is pretty much going to solidify your edge, that's going to be where you will have a proven approach. And once that's all said and done, we're going to introduce you to the biggest part of trading, which is psychology. So guys, without further ado, that is pretty much it. Hope you had a great time learning more. I do apologize for the amount of time it's taken me to get back onto this. I've just been enjoying posting all the other content, but I can see how much people are actually enjoying the course, and I got to do you guys a favor and finish it off for you. Gosh, silly me. But guys, thank you for watching. Hope you learned something. Anything confusing, pop some questions in the comments and I'll be happy to help you out. Don't forget to like, comment, subscribe, all that good stuff. Okay, have an amazing rest of your day, guys. Bye-bye for now.